Hey everyone, welcome back. Today, we're diving into something that causes more chaos in the crypto market than Elon's tweets: leverage. More specifically, how leverage actually moves the market, sometimes in totally unexpected ways. Let's start with the basics. Leverage means borrowing money to open a bigger position than your actual balance. In crypto, platforms like Binance, Bybit, and others let you use 5x, 10x, even 100x leverage. So, your $1,000 suddenly controls $100,000 worth of Bitcoin. Sounds powerful, right? It is, and a little dangerous. Now, when the price moves against a leveraged position, even just a little, things can get messy fast. If the loss gets too big, the platform automatically closes your position to protect itself. That's called a liquidation, and it's the part where your trade basically gets kicked out of the club. No warning, no refund. But here's where it gets interesting. Liquidations don't just affect individual traders, they can actually move the market. Let's say Bitcoin starts dipping. Some traders who were long on leverage start getting liquidated. Their positions get closed and automatically sold off. That selling pressure pushes the price down even more, which liquidates even more traders. That causes more selling, which, you guessed it, triggers more liquidations. It's a chain reaction, kind of like watching someone knock over the first domino and suddenly the whole thing collapses. But instead of dominoes, it's your portfolio. And this works both ways. If a bunch of people are shorting Bitcoin with leverage and the price pumps, it can trigger a short squeeze. Suddenly, everyone's forced to buy back their positions at a loss, and the price shoots up like a rocket, leaving a trail of liquidated traders in its wake. So, yeah, sometimes the market isn't moving because of secret news or a whale's tweet. Sometimes it's just millions of dollars in leverage getting wiped out in a matter of seconds. And speaking of whales, they love this stuff. Smart money knows exactly where retail traders are likely to put their stop losses and liquidation levels. So yes, they'll happily push the price just far enough to trigger a bunch of liquidations, scoop up cheap assets, and ride the bounce like pros. So, what does this mean for the average trader? First, leverage doesn't just boost your gains. It also amplifies risk. What feels like a small move can turn into a full-blown wipeout. Second, if you're going to use leverage, have a solid risk strategy. Don't just YOLO into a 50x trade because you saw it trending somewhere. And third, remember that crypto markets are often reacting to liquidations, not logic. That huge red candle could just be a liquidation cascade. That random pump might be a short squeeze in disguise. Bottom line, leverage is like strapping a jet engine to your bicycle. Could be fun, could be fatal. Depends on how prepared you are. Let me know in the comments if you've ever been liquidated, or if you're one of those brave 100x warriors out there living on the edge. Thanks for watching. Hit like, smash that subscribe button, and I'll catch you in the next one, hopefully before your liquidation hits.